Hi, I'm Koel Ghosh, Director and Head of Business Development, Asia Index Pvt. Limited. I'm here to talk to you a bit about index investing, which is alternatively known as passive investing. It is important here to understand the two significant styles in investing for us to have clarity. The two different styles are passive and active. Many of us are familiar with mutual funds. So we can understand that most mutual funds fit under the active management category. Active management involves the art of stock picking and market timing. This means the fund managers will put their skills to pick securities that they believe will perform as per their investment objective of their portfolio. Active management has two chief limitations that don't handicap passive investing. Firstly, cost. It's expensive to compensate active managers and to pay for the frequent trading costs of their buy and sell decisions. And secondly, results. Most active managers fail to outperform the market over the long term. Taken together, they undermine the investor return. A passive strategy instead seeks to match the risk and return of the stock market or a segment or the index strategy. It has significantly lower expenses as it requires no additional research resources. Its turnover is limited to the index changes, which are far and few depending on the type of index it's replicating. So we see that index investing has its advantages, that it does not depend on the fund management skills to provide the investment return, as it mimics the index and its returns. There is transparency, as investors can track the index and its performance and thereby compare portfolio returns. It also provides diversification across asset classes. There is a constant debate on active versus passive performance, and with reference to our Pvt reports, we have seen a trend in long-term returns in the large diversified categories in the favor of passive management. Preference to active and passive is completely based on investor risk return profile. There are many ways of asset allocation that investors and fund management can use to achieve their objectives. Hence, it necessarily need not be one against the other. Portfolio managers who employ core satellite investment styles can effectively use both passive and active styles to reach their goals. Some use active as their core, while others prefer passive. But it's important to understand the merits of each and thereby use the one that fits the case the best. So how can one invest in an index? We have two options, index funds and ETFs. To learn more about index products, watch the next in series, and for more information on S&P BSE indices, log on to www.asiaindex.com.